We head into this final Fed decision of the year with tension running high as U.S. equities falter and global sentiment deteriorates. All of this makes for what could be an interesting decision that sets the tone for a different outlook than what had been laid out to this point. Broadly speaking, the consensus expectation is for the Fed to deliver a dovish hike, delivering another 25 basis point increase while offsetting any hawkishness from this adjustment with guidance that shows the central bank hitting the pause button for a good portion or perhaps even all of 2019. In the lead up to the decision, there has been quite a lot of Fed speak expressing a shift in the outlook back to a more accommodative leaning, with the best example coming from the Fed chair's opinions of where policy is relative to the neutral rate. Months back, we were well off of neutral, and now we're nearly there. But what makes today's decision more complicated is the fact that on the surface, when looking at economic data, there really isn't anything that would suggest the Fed should be considering a pause with rate hikes or a deviation from its current path. Economic data has been broadly in line, and this comes with the Fed already expecting a slowdown in 2019 on account of the impact of the initiation of that policy normalization process. And so when considering these facts, the Fed should be continuing with those gradual rate increases. But the thing about this is that the Fed is contending with downside risks associated with uncertainties around White House policy, while also contending with this slide in the stock market. And to make matters even more complicated, the president has been aggressive in his criticism of a Fed policy that has been far too restrictive. What makes this interesting is whether or not the Fed will be more inclined to stick to the economic data and retain a more hawkish outlook so as to not look like it is being influenced by the president. But we still think there is reason enough for the Fed to scale it back into a more accommodative outlook without needing to feel like it has done so on the demands of the president. In fact, the Fed could just as easily argue that they are pulling it back because of those downside risks and unknowns associated with the president's policies. The threat of a government shutdown on Friday is just one more of those risks the Fed needs to consider. And so, on balance, we believe the Fed will indeed be more inclined to adopt a less hawkish outlook for now, as it takes time to see how many of these political risks play out and how the market handles the decline in equities. We wouldn't be surprised if the Fed makes a decision to actually even hold today, but we believe the base case continues to be one which sees the dovish hike. As far as levels go, using euro-dollar as a proxy for direction, we'll get more clarity on a break back below the 2018 low around 112.15 or on a push up above 115. Anything in between sends a message that the market did a pretty good job anticipating risk around this event. That's all for now.